and collaborating with ICRIER. I also thanked ADBI, the Asian Development Bank Institute, and Konrad Adenauer Foundation for collaborating with us in this effort. Louis has been a very good friend of ICRIER and personally, and he's the senior resident representative to India, Nepal and Bhutan since June 2019. And he has over a decade of experience with the IMF. He's been division chief, he's been resident representative in Peru, and he's a wonderful economist. And he's been helping us put this conference together, not only from IMF support, but personally involved in helping us get panelists and put the conceptual, intellectual underpinnings, especially for this session, together. So thank you, Louis, for doing this, and over to you for moderating this session.
Thank you very much, Rajat, for this kind introduction, and it's a pleasure to cooperate with ICRIER. You are doing very, very good work in India, and it's appreciated, and it's not easy. So it's really an honor to try to help in any way the IMF can do so. We have an interesting session today. But before we move on to that, I'd like to extend personally my deepest condolences, Rajat, for the untimely passing away of Ishner Judge Ahluwalia. She was a big figure in India in general and very close to ICRIER. So please accept the condolences in my name and that of my colleagues at the IMF. We knew her well. We know her husband well, Montek Ahluwalia, and they are really fine people. So I guess the world is worse off today because Ishner is gone. Turning to our session today, we are undergoing a period of profound changes and very significant shocks to the global economy. And in the last 10 years or so, a little bit more than that, we've had two really systemic global shocks. The global financial crisis in 2008 that sort of was epitomized or triggered by the Lehman collapse in September. And in the first quarter of 2009, we've had a synchronized global slowdown combined with a liquidity crunch that was quite intense, like never seen in recent times. You know, roughly 10 years later, we have a different kind of shock, a real sector shock, a public health shock, and the whole world is affected by this. I happen to come from Latin America, have a lot of relatives and friends there. Talking to people in India, South America, Europe, here in the US, it's really remarkable how the entire planet is being affected by COVID. So in this context, looking at the international financial system is very important because that was the source, at least the US banking system in its initial phase, of the global financial crisis. And after that, there was a prolonged period of reforming the institutions, the rules that guide the international financial business. And Basel III came out and has been pretty much implemented throughout the world. So the question is, how are we doing today after those reforms? And what is in store in the next 6 to 12 months? And to look at these issues, we have a very distinguished group of speakers. You have their bios, so I don't need to elaborate, but let me just briefly introduce them. Professor Alok. Sheel is very well known, the RBI chair professor at ICRIER, who's had a very distinguished career, including in public policy before his current position. José, Siaba, and I understand, Alok, that you're in Delhi.
Yes, I am indeed.
José Siaba Serrate who is in Buenos Aires, Argentina, is the chair of the task force of the International Financial Architecture for Stability and Development, and has taught and engaged in consulting in Argentina and elsewhere. And Jay Surti, my colleague from the IMF, is the Deputy Division Chief in our Monetary and Capital Markets Division that is entrusted with monitoring these reforms in the international financial regulatory framework, and who is finalizing a stint at the RBI in Mumbai. So we have people in Washington, yours truly, in Mumbai, Delhi, and Buenos Aires. In terms of how we will proceed, each speaker will have about 15 minutes to make their point, and I will be checking for questions. So if there are any questions, please use the chat mode. And after all speakers are done with their interventions, I will be presenting the questions to them. Any questions on how we are proceeding?
No, it's okay.
Okay, thank you. Shall we start with you, Alok, telling us the Indian perspective of what you've seen in these initiatives to reform the global financial regulatory framework? Thank you.
Thank you, Louis, and Rajat, and my fellow panelists, and ladies and gentlemen who may be, watching us. I have been asked to speak of my experiences in the G20 in the areas of the global financial architecture and financial regulatory reform. To tell you where I'm coming from, I represented India in the first 7 G20 summits. So my point of departure is naturally the global financial crisis of 2008, which was the trigger for elevating the G20, what was a finance ministers forum, to the summit level. Now, the global financial architecture on the eve of the crisis can perhaps be seen as a triptych, with international capital markets largely dominated by the advanced economies at the center. Then you had the bilateral and multilateral assistance on which developing countries were dependent on one side frame, and the large self-insurance mechanisms of foreign currency reserves of developing countries on the second frame. And these three frames themselves can be seen encased within the international monetary system, dominated by the US dollar as the de facto reserve currency. Now, emerging markets had long accessed international capital markets for commercial borrowings and private equity flows. These markets, however, exposed them to the vagaries of shifts in US Federal Reserve policies and sudden stops and BOP crises. And this is what happened during the Latin American debt crisis of 1980, then India's BOP crisis of the early 90s, and the Asian financial crisis of the late 90s. Now, the resources of the MDBs, however, did not grow in tandem with the external financing needs of EMEs. And this was a concern within the G20 as well. And EMDs had built up their own self-insurance mechanisms of reserves, aided by the strategy of export-led hypergrowth. One of the consequences of this was mounting global imbalances. And these were recycled to finance a consumption boom in several advanced economies, in particular the US, just like you had the recycling of oil surpluses, which had earlier financed a consumption boom in Latin America. Now, in the case of Latin America, India, and Asia, the consumption boom ended with sudden stops and BOP crisis. In the US, with the enormous privilege of the global reserve currency, the end of the consumption boom arising out of the reversal in Fed policy resulted in a major financial crisis emanating in the shadow banking system. So it is not surprising that weaknesses in the financial system was seen very early on by the G20 as one of the ultimate causes of the global financial crisis. The other major cause seen by the G20 was global imbalances. And the leader statements in the first 3 G20 summits at Washington, London, and Pittsburgh, they spelled out in some detail the direction of the reforms needed. One of the first of the 4 working groups set up by the G20, of which India was the co-chair, was on regulatory reform of the financial system. Now, alongside with this working group, the Financial Stability Forum, which was at that point a club of the G7 countries, it was restructured into the Financial Stability Board by including all developing countries, and this was under the overall guidance of the G20. And the Financial Stability Board was tasked by the G20 to monitor the formulation and implementation of financial sector reforms and report back to the G20, which it did. It periodically updated the FSB. The FSB periodically updated the G20 in all the finance deputy meetings, and I was present in many of them, and also gave annual reports to the leaders at the summit. The other issue of global imbalances was addressed through the Framework for Strong, Sustainable, and Balanced Growth, launched at the 3rd G20 summit at Pittsburgh. And the framework working group was to evolve into the flagship working group of the G20, and it is still very active. And as in the case of the working group on financial reform, India was also one of the co-chairs of the framework working group alongside Canada, and they continue to be so. Now, since emerging market financial markets were considered to be already fairly tightly regulated, they were not very engaged in the intense G20 debates over financial regulation. From what I saw, that this was mainly between the US and the UK on the one hand, who generally batted for a lighter touch regulation, if one were to generalize, and Europe on the other, which pitched for tighter regulation. Now, the emerging market concerns, including that of India, they were centered on evolving a consensus on macroprudential regulation that would enable them to deal with volatile and destabilizing capital flows, which was exacerbated at the time by large-scale quantitative easing in the advanced economies, and which complicated their monetary management. So while central banks were being applauded on the one hand for their swift action in stabilizing asset prices, unconventional monetary policies also came to be seen as a new source of froth in financial markets. And that is a concern even today, this two-sided view of unconventional monetary policies. And QE was also drawn into the debate in the G20 on global imbalances and currency wars. And this was the biggest talking point at the 5th G20 summit at Seoul. The prevailing orthodoxy at that time, underwritten by the IMF, was to move towards non-intervention in foreign currency market and full convertibility in emerging markets. In this, the emerging markets were largely able to get their way by negotiating some policy space. Their other concern was to build consensus on strengthening the global financial architecture by bolstering global and regional safety nets, and to increase their own representation in the governance, in its governance structure. Here too, they were successful, and as IMF's resources were increased, and their weight in its governance structure was enhanced. They were, however, not the direct beneficiaries of the enhanced global safety net to which they contributed, as this was mostly used to bail out countries in the EMU, which was passing through a crisis at that time. And the G20 emerging markets were largely self-insured because of their large reserves. The IMF procedures were also not considered nimble enough. And they were also wary of entering into advanced arrangements with the IMF on account of the stigma effect. And indeed, it was the US Federal Reserve that got off the block well before the IMF during the crisis through swap arrangements with major central banks to provide standby dollar funding. And so one of the surprising outcomes of the global financial crisis was the emergence of the US Federal Reserve, the issuer of the de facto global reserve currency, as a major pillar of the global financial architecture. The French presidency attempted to get the G20 to address this enormous privilege of the US dollar in the international monetary system at the 6th summit at Cannes. But nothing really came of this. And this is a reflection of the sobering fact that this is a status bestowed by markets. There's little that governments or the G20 and regulators can do about this. Now, the G20 financial regulatory reform agenda, as summarized by the FSB in the G20 meetings, was based on 4 pillars. A strong regulatory framework centered on implementing the new counter-cyclical Basel norms, Basel III, effective supervision that would bringing all major financial jurisdictions under the regulatory umbrella and addressing the dragon of shadow banking. C, resolution and addressing risk arising from systemically important financial institutions with focus on G-SIFIs and living wills. And 4, transparent international assessment and peer review, such as periodic stress tests of the financial system, which was already being done by the IMF at that time. So what are the major successes of the G20 on regulatory reform? So the first, as Louis pointed out, was an overseeing and implementation of the new Basel III capital and liquidity framework, which is largely in place. Then requiring originators of securitized instruments, because securitization was a major concern of the G20 at that point, to retain some skin in the game, to reduce moral hazard, then bringing all major jurisdictions under the regulatory umbrella, listing and monitoring of G-SIFIs, monitoring of shadow banking, and mainstreaming macroprudential regulation, which had so far been limited to developing countries like India to address pro-cyclicality. What were the major failures? Well, to my view, to this date, this comprises the inability to regulate shadow banking. It's another issue whether, by definition, shadow banking can be regulated, but the G20 has set itself a task of regulating shadow banking. Then compensation practices, regulatory divergence between Europe and the US, where there has been some rollback, and also in addressing the pro-cyclicality arising from the mark-to-market mechanism, on which there was a big debate in the G20. And this was very eloquently underscored at the time by Sheila Bair, the chairman of the US Federal Insurance Corporation. And it is expected that it is macroprudential policy which would address this issue of pro-cyclicality. So the G20 itself was the view that the robustness of its reforms in the area of financial regulation would be tested in the next crisis. And this crisis is now upon us. So it is the test of the G20 financial sector reforms. And as Louis pointed out, whereas in the crisis 10 years ago, the shock was in the financial system, which was transmitted to the real economy. Now the shock first is there in the real economy, and it has to be seen how would it be transmitted to the financial system. The central banks have taken early action, and the instability in March was addressed. But going forward, one has still to see how the financial sector will bear those stresses. Finally, looking back at my experience in the early years of the G20, now as an outsider, I'm struck by how much the big picture has changed. Global economic governance at that point was dominated by the G7. Emerging markets were still seen largely as recipients of aid. However, trend growth had stagnated and declined in advanced economies, even as fast growth in emerging markets was a major driving force behind the great moderation leading up to the crisis. So the relative weight of the emerging markets in the global economy had risen sharply. Their growth was also much less affected in the immediate aftermath of the crisis. It was therefore felt that the bigger emerging markets, particularly China and the BRICS, needed to be inducted as stakeholders in global economic governance. This was especially so since mounting global imbalances was seen as one of the major underlying causes of the crisis. And the G20 appeared to be the most compact multilateral forum for effective decision-making, which included the BRICS and the major emerging markets. And at Pittsburgh, the G20 designated itself as the premier forum for global economic cooperation, effectively replacing the G7. Now, with the tide turning against globalization in favor of economic nationalism, the decline of growth in emerging markets, the stronger recovery in advanced economies, and the decline in global imbalances, the G20 appears to have lost some of its sheen and importance in recent years. Whether the G7 has reverted to its former leadership role is, however, arguable, with the rise of China on the one hand and dissensions within the G7 on the other. And I would think that global cooperation of the kind seen at the time of the G20 over a decade ago now looks increasingly difficult. So with that, I'll stop, Louis, and hand it back to you.
Thank you very much, Alok. A very interesting intervention from a policy practitioner. Basically, you described the landscape where these things were discussed and raised some of the issues, as well as the perspectives from developing countries, emerging markets, and advanced. So thank you. We'll come back to you after the other speakers have had their turn. Shall we turn to you, Jose?
Yeah, why not? Here I am. Thank you, Luis. And thank you, ICRIER, for your kind invitation. Let me start analyzing architecture, the financial architecture and regulatory reform of the last 2 decades by telling you a tale of 2 crises: the Lehman crisis and the current COVID-19 saga, I would say, because it seems it will come in waves. We have already had the initial impact, but we cannot discard a second wave of contagion and severe lockdown. Relative to the Great Recession in 2007, 2009, right now the real shock has been far more devastating. But strangely, this time, no financial crisis occurred. And that's quite remarkable. The Bible says, you will know them by their fruits. And I think the fruits after this initial shock are worth praising. Keep in mind that the US lost 8.5 million net jobs throughout the Great Recession. In comparison, just in April, 2 million, more than 2 million, more than 20 million net jobs were destroyed in just 1 month. That was more than 14% of the US civilian payroll. And that was an unprecedented southern blow. It took the Great Depression almost a year and a half to create similar damage. So you might ask, where is the credit crunch? And really, there's no credit crunch. So this did not happen by sheer luck, and there's merit in it. And I think regulatory reform has proven to be at least walking in the right direction. This time there's no banking crisis. I think that's a key element that explains recovery, not only in financial markets, but also in the real economy. We are seeing economies growing again from a very low base, but growing again. So I would say that against all the odds, finance was this time a source of confidence amid disruption. The financial ecosystem proved to be resilient indeed. Financial markets suffered a heavy dose of initial turmoil, but they absorbed the shock very fast. I would praise macroprudential regulation and special buffers incorporated by post-Lehman legislation that limited bank risk exposure ex ante and added extra layers of capital and liquidity requirements that proved to be able to provide a safety cushion that could be relaxed after the shock and let banks operate counter the cycle, as the spirit of the regulation suggested. So the financial system was resilient. That means it was able to absorb the shock, to recover, and to adapt to the COVID-19, I would say, temporary shock, or the size of the shock we have faced up to this moment. Financial markets recovered strongly starting on March 23rd. We know the precise date that the markets, bond markets, and the equity markets turn around. That was pari passu. The world was entering severe lockdown. The very influential Imperial College paper written by Neil Ferguson and others was published in the midst of March. So 1 week again, you were seeing the main economies entering lockdown. And in that week, in March 23rd, markets turn around due to some initiatives communicated by the Federal Reserve, as it was said. Central banks were early in their response, and they were incredibly effective. This time, I would say, markets improved impressively in April, despite initial jobless claims in the US, for example, were increasing by the millions. Jobless claims grew more than 50 million in April, May, and June. And at the same time, the stock market in the US was 30% up. Net credit this time was not destroyed by the shock, but expanded. Banks were able to expand their credit. Bond issuance, which is, I would say, we have some linked miracles. Bond issuance is a miracle of a higher degree. skyrocketed in these tough conditions. Not only high grade or high quality bonds, but also low quality bonds, non-investment grade bonds, and even emerging markets bonds, which are under no man's umbrella. They have no central bank able to protect or rescue them. Nonetheless, bond issuance increase in markets. Keep in mind that, for example, before the pandemic, Boeing was in talks with the US Treasury in order to arrange a rescue for the company. And that was not needed. Markets provided the financial assistance to Boeing, and Boeing went through their crisis without needing to ring the tone of the Treasury. Even stock markets records above pre-pandemic levels came later on. So this time finance was not a problem to solve as in 2008, 2009, but I would say a working solution available to stabilize the real economy. And stabilization came first from the financial side of the economy and then helped the real economy recover. Ironically, I have to say that finance is clearly not on a sustainable track. Excesses and fragilities are still plenty. Finance has many sustainability blind spots. And while effective monetary and fiscal policy paths, I think, are stretched to the limit. Real debt is escalating crisis after crisis against a backdrop of aging demographics. However, finance proved, even with its weaknesses, a powerful tool. But I would say that threats loom large and broader changes are overdue. We mentioned that there was no credit crunch. I think there's a combination of architecture or hardware and software. And the interaction between the two were the very effective tool that let us escape our destiny with the COVID crisis. I think the key combination of Basel III or Basel III type normative like Dodd-Frank legislation, plus active, intelligent economic policy was a fundamental factor to explain why the crisis was so severe in the real economy and not so much in the financial side. I think that rapid, very well communicated central bank, for example, the Fed intervention, plus fiscal policy, were the elements that provided resilience to face the public health crisis impact, which was completely unexpected. And if you go back to the papers, you will read in March that this time the Fed had no instrument to deal with sickness. They wouldn't be able to cure COVID-19, which was obviously right, but they were able to be very effective against attacking the adverse effects of the sickness. I would say that having credibility was key, as the central bank said that they were able to buy, to purchase in debt, private debt, in the secondary markets. The markets turn around, and you have no run against the bond market, which was kind of an obvious conclusion that you have ex ante when you know the pandemic was so acute. And I would say that credibility let you have more policy space, and the fact that you were able to utilize policy space, that also had a very strong positive feedback effect. If you look at the details, I would say that central banks are going and using all the library, I would say. I would say what they have done is a Bagehot recipe or dictum in some kind reloaded. I think there's a secret mix behind the Fed special programs, which were so effective in turning around expectations without, at the first time, without even spending any single dollar. It was just communication. It was just forward guidance that was very effective. That mix is a mix of monetary policy plus fiscal policy, and fiscal policy in the US at least had two ingredients. A very active intervention of the Treasury. You have to remember that the bylaws of the Fed were changed after Lehman, and now to do what the Fed has done, they need the Treasury to back them. Without the Treasury, the Secretary of the Treasury signing and saying that he approves the plans of the Federal Reserve is not allowed to intervene the way they've done. And Congress, in an electoral year, in a very divided country, Congress was indeed very rapid, very quick in reaching for an extra budget at almost no time of advice. Even we might say, don't we have a case of central bank dominance? We are combining monetary and fiscal policy, but this time it's not fiscal policy what triggers monetary policy response. 2 weeks ago, Jerome Powell, the Fed chairman, was telling Congress that please don't make he distribute thousands of small loans to SMEs, that he has no capacity to manage thousands and thousands of loans below $1 million to a lot of scattered SMEs. So that's the job of the Treasury, but this time you see the Treasury giving all the money to the central bank. I'll let the central bank fix not only monetary policy problems, but also fiscal problems. So in a sense, this is a huge change. And I think it's linked to a more solid base that partly is due to changes in regulations 10 years after the Lehman crisis. So in that sense, this is also very impressive. And I would say that we are starting to see a change in policy monetary approach by the Fed inclining themselves to use this flexible average interest, flexible average inflation targeting method that they have announced in Jackson Hole. And you have here Ms. Lagarde saying that maybe the ECB will follow. So they will try to target inflation rate, letting the average go a little bit above what's their long-term 2% target. As it was mentioned, I think G20's role is lesser than in 2008, 2009. I agree on that completely. I think the US and China confrontation is the main reason why this is happening. I understand that we have had some cooperation and some coordination. Clearly, the liquidity swaps, the 15 lines that the Fed established with different central banks was a very powerful tool. This time was utilized less than in the Lehman case because it was so effective. But mainly what we have seen is policy harmonization due to the virus, due to the very aggressive symmetric shock we all faced. And that's why things work out so well, for example, for emerging markets, which were able to issue new debt under these tough financial and economic conditions. I will say also that EMIs are now missing two crises. There was a pre-announced crisis in 2011 that did not happen. That was when commodity prices plunged, and there was no crisis in emerging market against the odds. And now, for the time being, we are also escaping from a massive crisis due to the pandemic and due to the retracement of commodity prices, of trade, international trade in real volumes, etc. We might ask if they will be able to survive a second wave of COVID-19 or a second wave of lockdowns, which are the most dangerous things. Obviously, debt has increased, uncertainty on the effects on output and long-term potential growth rates in EMEs is high, but for the time being, the only new country in difficulties, Ecuador, has already solved their problems, even though we also lacked a very clear-cut debt resolution mechanism. Both Ecuador and Argentina were able, maybe courtesy of enhanced CACs, to fix their problems with their private creditors. I'm not so much convinced of the quality of these arrangements, but also compared to the past, this seems to be working better because of some enhancements and changes made in regulation in the last few years. There's a problem of stigma. I think Alok mentioned that. That was very clear when debt relief for highly indebted poor countries was announced, which has to be dealt with. And I also like to go back to what Alok mentioned. I remember in 2009 in Pittsburgh, there was a mechanism which was very interesting called the Mutual Assessment Process, or MAP, that seemed to be a very good instrument of macroeconomic policy cooperation. And clearly that MAP has completely fell into oblivion, which is, in my opinion, a pity. Looking ahead, looking towards the challenges we will face ahead, I will mention three topics. One is this USA-China confrontation. You may ask, is China building a new parallel international financial architecture? Is China, for example, a kind of global subprime creditor for many countries in Asia and Africa? If that's the case, and in some sense that's an initial case, I would say there are chances that short circuits between the old traditional Western system and this Chinese system, short circuits may appear. For example, is the IMF the lender of last resort of the world and China a free rider if some problems happens in a country that owes money to Western banks and investors and to China? Well, that's an open question mark. So I think we will have to deal with this issue. As it was said, G20 cooperation was less than in 2008. It becomes more difficult, as Alok said, but it will be more needed. So it will be necessary to have a level of cooperation or talking between these two countries and maybe the G20. And I think right now the G20 is the best platform we have in order to deal with this. I have mentioned two crises. I think that we are facing a third crisis on the horizon. This is, we know that we have just 10 years to stop the climate tragedy on the horizon by climate warming. So I think we can stop it. If not, I hope we will have plenty of years more in order to fix. So knowing that, and as the pandemic, you cannot say this is a black swan. This is something, you know it's coming. You know climate change is coming, is hurting you. Insurance companies know that and have been, maybe because their ability to think more long-term, they were able to fix their policies, and they are navigating well despite the invoice coming from global problems is going up. And I would say that, so in that horizon, sustainability has to go from a piecemeal approach to be fully embedded in mainstream finance. And that's a need. For example, you have a central bank and supervisors greening for the financial system network, and they are suggesting that climate risks belong into central bank's mandate, and they have to be integrated within monetary and financial frameworks. And I think we have to be very active working in that way. And I have to add that a revamped financial approach will not lead the overall sustainability agenda. So it has to come the other way around. So finance needs politicians that have made so many pledges to the future to work in a workable sustainability agenda with clear goals, missions, commitments attached, and then finance will have to adapt that agenda within their instruments and procedures. And last but not least, I would like to mention the impact of digitalization. We have seen it in the pandemic, how contactless payments were so useful, how logistic came to be so unraveling if you have to deal with cash and you can substitute it very easily. You have seen the problems just to send a check to any single citizen because you have no clues how to do that. Many things can be done by digitalization. And given the pressure, companies had advanced in just 1 year what they would have done in several years in this area. I think digitalization is also impacting finance in many ways. We are going towards less bank-centered payment systems, and that's very important. For example, in emerging countries, where you don't have huge banks, but you cannot disconnect a bank in a crisis because you will also disconnect the payment system. Now digitalization is letting you have another circuit of payments that not necessarily will go through the banks. You are seeing big tech entering finance or trying to enter. You have seen the impact of Libra, of the Libra project on central banks. So I think that's a very important change because even in terms of CFIs, big tech players are way bigger than our bigger banks. So they might come to be our too big to fail in the future. You are seeing the emergence of the eruption of central bank digital currencies due to the impact that Libra has caused in expectations. Now, China is having its own digital currency, which is a very small project. They are substituting just M0, just conventional cash with digital cash, but they are in a pilot test in 4 cities. But I think that they are the first ones. They won't be the only ones. The ECB last week mentioned that they are planning to have their own digital currency by mid-2021. So that's another huge change in block. Monetary policy can be effective by digital currencies. Many things, for example, Horizon helicopter money can be done using digital currency with a proper design. So that's another area of huge change. I would say digitalization will drive different banking and credit models, or could do that. And last, I would like to mention Mark Carney's proposal of a new international monetary system architecture that he made in Jackson Hole last year, 2019. And I will mention it because it has many points of contact with what Alok said about the role of the US dollar. Citing Carney's words, he said in Jackson Hole last year, let's end the malign neglect of the international monetary and financial system and build a system worthy of the diverse, multipolar global economy that is emerging. Carney was able to think of Libra as a currency able to be the international liquidity currency, which would be a private sector issued money, which seems a little bit too aggressive. But the other the other alternative that could emerge if we have central bank currencies, digital currencies all over the world, is to create a synthetic hegemonic currency, as he mentioned, that is a basket of central bank digital currencies that could play a role. Not instantly, it will take a lot of time and political accords, but now technology is letting us think of things that we know that Mr. Keynes and Mr. White were talking about in Bretton Woods, but they were very hard to do, and now technology will let us do and tackle these things. And many of the problems we have seen in the financial system are due to the basic architecture, just not how we regulate banks, but how the system is wired. If we might have multiple reserve currencies, for example, we might increase the supply of safe assets. We would not depend only on dollar assets or in US treasuries, and that will have an impact, a key impact in many things, even in the equilibrium interest rate, international interest rates. It will reduce spillovers from the core of the system from the US, and in that way, it will lower the synchronization of trade and financial cycles. Keep in mind that concept of Helen Ray of the existence of a global financial cycle that does not depend on national economic cycles, that depends a lot on the dollar and on US monetary policy. Think that US monetary policy is managed having the US economy in mind, only that or mainly that, and the world sometimes goes for through another path and would need another thing, and a synthetic currency might play that role. So it can weaken the global financial cycle in capital flows, asset prices, credit growth. That will reduce fragilities, and I would say that would make capital flows more stable, which is something that EMIS would like and need a lot. Thank you, Luis. I hand this out to you. Bye.
I think you need to turn your microphone on.
You're mute. Louis, you're mute.
Okay.
Thank you very much, José, for a very interesting intervention comparing both crises, the global financial crisis of 2008-9 with the COVID crisis, and overall giving a positive assessment of how the regulatory reforms of the last few years, mainly on capital and liquidity of banks, have helped weather the current crisis. And in fact, the credit crunch is not a problem now like it was intensely in 2009. A number of issues you raise, which we hope to get to at least some of them in the conversation. After Jay tells us about what has been happening more precisely on the global regulatory landscape, and where do we go from here? So Jay, over to you.
Thank you, Luis, and thanks very much to ICRIER for having me as part of this panel. My presentation will really focus on my own personal views and should not necessarily be construed as reflecting the views of the IMF or IMF policy. Let me just join both Alok and José in their description and differentiation between what happened in the run-up to 2008, 2009, and what has happened in the run-up to the current crisis that is ongoing. Of course, in many ways, the genesis of the previous crisis was the enfeebled state of regulation in terms of coping with the types of financial innovation, including by the banks, that had taken place, and the weaknesses and vulnerabilities that had accumulated in the global banking system in the run-up to the Lehman event and then the GFC. Whereas in the run-up to the current pandemic-driven crisis, banks, as a result of the GFC, are in a much stronger position than they were. And so also is regulation. We've been through a process of an international framework to strengthen common minimum standards. And there is a lot of work going on, still spearheaded by the G20, with the FSB, the standard setting bodies, the international organizations, and of course the country authorities, recognizing this is a continuous process in a way. But what this leads to is the first point of focus of my discussion and contribution here, which is that banks and regulation are in a place right now to contribute potentially a lot more in terms of a counter-cyclical response to the current crisis, much as they were driving the previous crisis. So the first set of questions I would like to address is, how can regulation and supervision help in countering the impact of COVID-19? And what are countries already doing in this regard? We will ultimately see the back of this crisis too, just as we saw the back of the previous one. And that brings me to the second set of questions, which is that once we have sort of gone over the peak and sort of coming to the end of the tunnel of this particular crisis, what will be the long-term priorities for global regulation and supervision? Now, turning to back to the first of these questions, when I said that I believe that regulation and supervision have an important role to play in countering COVID-19, what do I really mean? I think this is in two senses. First is they can play a direct role by providing banks and other regulated credit intermediaries the necessary space that they require to maintain credit, both to viable existing borrowers, but also to new worthy borrowers. And when they do this, when these policies do this, they also contribute indirectly because they increase the effectiveness of accommodative macroeconomic policies in attenuating the pandemic's impact on domestic demand. So, of course, regulation will play a direct role, but it can also play a very important indirect role in complementing and supporting other policies. Now, how would regulation and supervision do this? What should be the approach? What is the approach? It's all about striking a balance. On the one hand, there needs to be some type of counter-cyclical action that comes from regulatory policy and from the supervisory approach. But on the other hand, this should all come while safeguarding core long-term objectives of supporting institutional and systemic financial stability. So, more concretely, on the one hand, banks should be encouraged to restructure loans and to use the flexibility that is embedded in the prudential framework to continue supporting viable firms and supporting domestic demand. But at the same time, the confidence in the banking system can only be maintained by ensuring that losses are accurately recorded, reported, and provisioned for, and prudential standards that have been secured after a long, hard battle and after going through a very expensive previous crisis are not compromised, are not watered down. Now, this is very general, so I think a legitimate question to ask at this stage is, what do I mean? How do supervisors and regulators go about doing and striking this balance? So, what should supervisors do on the counter-cyclical side? Very broadly still speaking, two things. First, to use buffers that are already built into enhanced post-GFC regulation, and there are quite a few of these, and we'll come to specific examples very soon. And second, to complement this relaxation, to complement the use of these buffers by undertaking a permissible interpretation of standards. That's just one example, to use proactively wherever possible and wherever prudent, forward-looking accounting rules. So this is on sort of providing some type of counter-cyclical support. What about the balance? It's important that supervisors prevent backpedaling on internationally agreed common minimum standards and corresponding progress that has been made in various countries on domestic regulations. And second, to ensure that the resources that are directed towards distressed borrowers are done in a transparent way, where the targeting is astute and correct, and where it's clear that this is being done on a temporary basis to preclude moral hazard, and to make sure that credit risk management practices in the private sector are not watered down. Okay, so now this is all in terms of still fairly general level. So I want to actually drill down to what are the specific policy initiatives that have already been undertaken in several countries, both advanced economies and emerging markets and developing countries. Now, first, in terms of regulatory policies or using regulation to support the economy, to support the financial sector, at least 15 countries as of early September that I'm aware of had undertaken or had encouraged banks to undertake measures which can be considered to be dealing with distressed borrowers. Now, what do I mean by that? Supervisors were actively engaged in encouraging banks to engage in loan restructuring by either renegotiating terms or providing some type of moratoria or grace periods, so on and so forth. But importantly, to do this in a way, do this restructuring in a way that was commercially viable, that is, the decisions were commercially viable. This was considered by these countries as being preferable to avoiding deadweight losses that were forthcoming by choosing instead to go in for foreclosures or to seize or liquidate collateral or to use out-of-court and legal settlement processes. So these were all measures that were directed at dealing with distressed borrowers. As I mentioned, there are also the new post-GFC regulatory reform process has also led to the creation of certain buffers within the regulatory framework. On the side of and at least 70 countries by early September had been actively encouraging their banks to start using these buffers to support the economy. On the capital side, in most countries where banks had accumulated counter-cyclical buffers, and these were in place, these authorities have encouraged banks to use these buffers actively to support lending. In many countries, beyond the counter-cyclical buffer, banks have also been encouraged and should be encouraged to use the capital conservation buffers. And in some countries, Sweden being a prominent example, banks have a systemic risk buffer, which also authorities have encouraged banks to start using, all in order to support lending. Now, there are a few caveats to using these buffers, and I want to sort of mention them in the same breath. When I mention this, a systemic risk buffer, I don't mean GSIB or DSIB surcharges. If you remember, one of the key pillars of the G20-led regulatory reform process after the GFC was the erection of new buffers, which was to discipline the moral hazard of too important to fail. So when I mention using systemic risk buffers, I mean to exclude these types of GSIB and DSIB surcharges, which are meant to contain model hazard. Similarly, in a similar vein, there are several countries, emerging markets and developing countries in particular, where the banks did not have a countercyclical buffer in place or had not accumulated enough resources under this buffer. Now, this still leaves in these countries several institutions, several banks, where the level of capital that these banks had when the pandemic hit was well above regulatory minimum. So the same principle should apply, which is that if you have a surplus amount of capital, you should in general be allowed to use it to support credit, to support the real economy, provided that this capital was not put over and above the regulatory minimum because supervisors had identified institution-specific weaknesses. Okay, so there's a safeguard element, a caveat here in a way. Just as there are buffers in the capital structure, there are also inbuilt buffers in the use of liquidity buffers under Basel III. And authorities have encouraged in the ECB or Norway or the US or Hong Kong, have encouraged the banks to use the HQLA. And in certain emerging markets and developing countries like Brazil or Ghana, have encouraged their banks to use FX reserves accumulated under regulatory requirements, were they during the pandemic to face extraordinary liquidity pressures that were to come up. Now, of course, usually when supervisors have done this, they have balanced this by compelling the banks who use these buffers to go in for enhanced supervisory reporting so that they can make a continuous assessment of the nature and duration of use of these buffers. The main concern that supervisors may have in this regard is that at some point is the viability of the institution itself threatened, in which case the supervisory approach may actually start differing from what I have been describing. I mentioned supervisory approach, so it's perhaps essential that we come to that. The supervisory approach may itself require some modifications relative to normal times. For example, adhering strictly to resolution triggers may not be the best approach, even for banks that have been hit especially hard by NPL problems. This is true insofar as these banks are following loan classification and provisioning policies according to the regulatory requirements. In such cases, temporary and special supervisory measures may actually be preferable. The third thing I would like to mention is that while supervisors give a little more latitude to banks which are keeping to the regulatory requirements, it will still be necessary and prudent for them to require systemic banks to strengthen their recovery plans. I think in all of these things, it sort of makes sense that as the crisis subsides and its impact becomes clearer, banks should be required to submit medium-term capital restoration plans. And such departures from the supervisory norm, and indeed all such regulatory relaxations, are not made available to those banks which clearly had identified weaknesses and viability problems before COVID-19 actually hit the global economy. Because those banks are special, those banks actually were in trouble, and their troubles had nothing to do with the pandemic in the first place. So giving them relief would be increasing model hazard within the system, something that you want to prevent. Now, some authorities have already been highlighting some practical challenges with rolling some of these things out. One of the common problems is that banks which have been encouraged to use these relaxations have often been reluctant to actually use the buffers that they have. And an important reason for this is that when banks use these buffers, usually they trigger certain other mechanisms within the regulatory framework, which are meant to prevent model hazard. In particular, when banks use countercyclical buffers or the capital conservation buffer, they are no longer allowed to give capital redistributions for shareholder dividends or management bonuses. This is essential But banks are afraid that if they were to trigger these mechanisms, they would be creating market stigma. So authorities have been coming up with ways to prevent banks from not using the buffers available to them. And a couple of measures which have turned out to be quite popular is the consideration of introducing a sector-wide restriction on payouts, which prevents stigma to individual institutions which may start using the buffers. And to complement these types of sector-wide restrictions with a clear communication policy. What might this communication policy entail? It entails supervisors going out and communicating to markets that when markets see banks using regulatory relaxation options, when they see banks as a result not being able to pay out dividends or give management bonuses, that's not because these banks are weak. It's actually because these banks are viable and therefore are able to actually use these relaxation measures in the first place. So in a way, when supervisors are using these policies, having a targeted communications approach and an enhanced communication strategy to maintain market confidence is quite important, is quite essential in order to make these policies work in the first place. I mentioned capital redistribution. That's often a quid pro quo, but there are also certain caveats that must be borne in mind when authorities, when regulatory authorities roll out these relaxations in a way. I think the most important basically is the restriction on capital redistributions. Why are these necessary? You don't want banks to use the funds which are meant to support credit to pay out dividends and to pay out management bonuses. That's not what banks really need to be doing at this point of time. Now, besides the intention, there is also the uncertainty. We are not done with COVID-19. As José said, we expect a lot of bumps along the road. The pandemic might actually spring back in the advanced economies during winter. There might be second waves in emerging markets, so on and so forth. So when you give these relaxations, you also want the capital to be conserved for where it's supposed to go. A bank might be doing well today, but if there are a lot of bumps down the road, it might end up being quite weak later on. So in some ways, capital redistribution limitations are sensible, are prudent, especially in a time of heightened uncertainty. Now, supervisors may face challenges because if you are a viable bank and you are a listed institution, a supervisor may not have the legal authority to impose a restriction on capital limits. So that's another reason why imposing a generalized restriction on capital redistributions may actually be a good way to go, because you're preventing the sector itself from redistributing capital. Just as capital redistributions are not such a great idea today, relaxing or deviating from internationally agreed common minimum standards is not such a great idea either. So when I've talked about relaxing capital requirements or relaxing liquidity requirements, I'm not talking about relaxing regulations. It's really about the fact that Basel III, which most countries have adopted in some way or the other, not necessarily fully, has some inbuilt buffers which can be used in a counter-cyclical way. Again, the reason for not going beyond these buffers, not actually relaxing core regulatory requirements, is that this has been a hard-fought battle. Basel III was agreed in 2010, but the implementation calendar stretches till 2029. It's a remarkably long 19-year implementation calendar. If you already start watering this down, the longer term implications could be stretching well beyond the pandemic, and you don't want that. And of course, as I mentioned, there are a lot of uncertainties about how severe the pandemic is going to be. So you don't want to actually leave a lot of banks in an unviable situation if the pandemic lasts longer than expected and is harder than expected in several countries. I'll be brief about other types of caveats. While you are relaxing restrictions, while you're encouraging loan restructuring, you want to watch out for moral hazard. So I already mentioned that you don't want to give relaxations to weak banks where the weaknesses predated the pandemic, You don't want to restructure loans to borrowers on firms who were weak before the pandemic. You want to encourage banks to start planning their capital restoration once you know that you are with some degree of certainty over the worst. And similarly, you want banks to basically start recording NPLs and start provisioning so that they have incentives to push borrowers to start paying back the loans once the worst is over. All right, so that was sort of life in the pandemic. I want to talk just a little bit, very briefly, about what we can expect after the pandemic. And it's good to start with where the reg reform agenda was before the pandemic hit. The focus was on implementation monitoring and impact assessment. And that is a process which I think is likely to come back fully online once this pandemic is over. And I think that those components are actually extremely important. The financial innovation process in relation to the state of regulation is a continuous one. And so just as Alok mentioned that the shadow banking agenda is an unfinished one, related to that, or closely related to that, the rise of non-banks within the financial system will need continuous regulatory attention well after this pandemic is over. The low for long challenge, again, is going to continue, at least in the advanced economies, but also increasingly in several emerging markets. And this will affect financial intermediation and financial stability. This will require further thinking and further action on the part of regulators. Looking for new benchmarks like LIBOR or replacing LIBOR will remain important. There's been a pause button that's been pressed, but it will have to be unpaused soon. And this whole bucket of issues Jose talked about in detail, but which I'll just touch, which is technology and finance, and how the entry of big tech impacts emerging markets in developing countries. How can regulators and supervisors use technology just as the private sector is doing to improve regulation and supervision? And finally, developing effective supervisory strategies to handle cyber risk. These are all going to be challenges which are going to be with us and are going to increasingly become important as we sort of have dealt with this pandemic and sort of left it by. Let me stop here. I think I've done.
Thank you very much, Jay, for a very clear description of where we were before COVID in this area, what governments have done in terms of the policy reaction to the shock of COVID, and the agenda going forward. So we've had 3 very interesting presentations. We have about 15 minutes left for questions, and we have a few already. So let me go straight to the questions. After noting that we've heard a lot on global cooperation, on policy tools to face the current situation, on the volatility of the international economy, and 2 systemic global shocks in the last 10 years or so. And we focus on the health of banks. And the emerging opinion is that given the reforms of the last few years, especially on capital buffers and liquidity, banks are better off today, particularly the large systemic banks that can cause headaches in many places. They are in better shape than they were 10 years ago. Now, the question is the following: given that COVID is not under control, and if you look at the WHO daily charts for global cases, it's still going up. And if you look at averages, it has sort of stabilized, weekly averages, at very high rates. So COVID is very much with us, and it's migrated, obviously, from China to Asia to Europe to the US and to the rest of the world. So in a sense, it was the opposite direction to what the global financial crisis emerged. So in this context, let me pose 3 questions, one to each panelist, just to get the questions in. Maybe you can take 2 minutes each to respond roughly. On global cooperation, Alok, you've been an observer and a participant in these processes for a number of meetings. Given the state of international cooperation, the sort of less support there is for multilateralism, for international cooperation, what can the G20 do as an institution to push this agenda forward? And obviously, international financial regulatory issues are key, but José also mentioned others. Climate change, for example, is something that will require a lot of international cooperation. Jay, given that the G20 has lost some of its energy and in the last 10 years or so, does this affect the policy space that emerging markets have? And can they respond in ways to attenuate the growth impact of COVID? And José, you mentioned that the banks are better off today, in part because of the important reforms that have been implemented in the last 5 to 10 years. But again, COVID is not gone. It's here. And many regulatory authorities have introduced forbearance, moratoriums on debt payments. Having an exit strategy for these policies will be challenging, as Jay mentioned, and he talked about some principles to keep in mind, keeping the balance between what we've advanced and what the situation is today. So are we out of the woods? Are banks out of the woods? Or can things still change going forward? Thank you. Maybe starting with Alok.
Okay, Louis. So you asked me to speak on what are the prospects of cooperation within the G20, how it can be more effective in the current situation. In my talk, I was a little pessimistic on the interventions of the G20 in the current environment. Maybe I've gone to the other extreme, because when I participated in the G20, the early meetings, I mean, it was like a brave new world, and here's a new institution which is going to be the executive committee of global governance, and you're going to have the emerging markets and the advanced economies, coming together and solving global problems, and problems are increasingly global. But one has to keep in mind that although there was a lot of global cooperation, it was largely a consensus which emerged through hours and hours of discussion. There was nothing legally binding. There were no legally binding agreements which the G20 reached. So they reached a consensus, and then the countries went back and they, did the best they could within their own domestic political consensus. So that has always been the case in the G20 to actually evolve a consensus. But now, even to evolve a consensus on issues like trade and climate change, in fact, trade and climate change were always contentious issues in the G20. It is not something new. Right from the second summit in London, I remember, there were a lot of discussions on climate change, and nothing really substantial, I think, came out of it. It is the discussions in the UNFCCC where some progress was made on climate change. Similarly, on trade, on the Doha round, there's a lot of talk in the G20 to take the Doha round to a successful conclusion. But after some time, it became a joke. The G20 did not know whether to refer to the Doha round because it had lost credibility. And if it did not mention Doha round in its documents, it would seem that the G20 has given up. So, you were within, it had become some sort of a, a catch-22 situation. So right now, in the current environment of, firstly, that de-globalization and economic rise of economic nationalism, and then this confrontation between two major stakeholders, the US and China, within the G20. I think China is a rising power which has risen and it has still to be properly accommodated within global, in the post-war global governance system. And until that happens, I think the sense of the cooperative spirit may not be forthcoming soon.
Thank you very much. Jay, over to you.
Sure. Let me focus basically on the post-COVID landscape in sort of addressing your question. I think if we go back to some of the last points I made about what are likely to be the priorities of the G20 and FSP-led processes or coordinated processes with regard to the issues that need to be understood and tackled. Most of these actually are equally relevant to emerging markets and developing countries as to advanced economies. So let's look perhaps at what are immediate challenges to financial stability. In a sense, some of our work in the GFSR and in other sort of outputs over the last few years has tackled the question of what can we expect out of a long period of low growth, low equilibrium growth, and low asset returns and interest rates in the advanced economies. And sort of one of our common insights is that this might encourage capital to flow to high growing economies. Now, this is on the one hand an opportunity for emerging markets, but it also, since the capital is being sourced from outside, it also brings a potential financial stability challenge. So in a way, this is a challenging policy issue, which will have implications for regulatory policy for advanced economies, but equally so for emerging markets. And again, like global capital standards or global liquidity standards for banks, this might trigger some deep thinking about what to do about shadow banks and non-banks. So we know that already after the GFC, an increasing amount of the percentage of global capital is being intermediated by mutual funds. And these mutual funds used to be looked about as not so much prudential issues or financial stability issues, and more about investor protection issues. But we've come to realize that even within the boring world of passive indexed mutual funds, hide a lot of potential financial stability problems, not just for source countries, but also for recipient countries. So actually, I would expect that a large part of the FSP G20 agenda, which is already sort of being thought about, is going to remain relevant for both advanced and emerging market countries. The question, I think, is about if there's a changed political landscape, what will be the nature of deliberation of the type Alok was talking about? But I think that is something which we'll find out as we sort of move into the future.
Thanks. Over to you, José.
Thank you, Luis. Your question was, were we out of the woods? The answer is obviously we are not. We will never be in this business. This is a continuing process. When you fix one problem, you're building your next one. But I would say several things. On the G20 agenda, I would separate the finance track and the other tracks. And the finance track is more professional. It has a financial stability board. It has a permanent agenda and people always working on the issues. And if they don't, when a crisis arrives, they are aptly joined together. And so I have more faith on the capacity of the G20 to solve problems on the financial track than on the other tracks it has gradually been incorporating. That was one point. when we talk about post-COVID, we really cannot assign dates for that. We might be post-lockdown, but stay having to live together with COVID. So that's a problem. The COVID timeframe is not defined, could be longer than what we expect. And that's a huge problem, because I think our architecture is designed to absorb one shock mainly, and then you have to go there and try to fix things after the shock. And if you will face successive shocks, maybe our financial architecture is able to absorb the first one, but if it prolonges, it might be unable to lead or to solve further pressure. And really, we do not know how much pressure will come with COVID. We hope there's no COVID-21, or if it's not harder or tougher than what we have seen, and we hope for a vaccine or for an effective treatment. But if these things do not come, we might get into trouble later. We might have a financial crisis after some time if bankruptcies and
let's see if he reconnects.
Because I think we've lost him.
Yeah, let's, because we only have a couple of minutes left, let me try to wrap up and thank ICRIER for organizing and the speakers for their insightful comments. We've talked about many issues. It's clear that COVID has affected all of us, personally, professionally, socially, from every angle. At the fund, we're seeing 2 or 3 things in response to this. José,
well,
are you?
now I'm back again. It was.
Okay, go ahead. Why don't you wrap up your intervention?
Yeah, well, I would say we were facing huge uncertainties here. What we know for sure is that debt has increased for almost all the players, that we might find liabilities in the future that are not quite clear right now. And we have to be able to deal with these COVID crises for quite a long time. So we cannot sing victory yet. We have to be prepared to be put under pressure. I think the financial side is prepared for that, but if the pressure is too much, we will have problems, and there's no easy solution. That's it.
Muchas gracias, José. Thank you, José. There are a few things we know in the midst of lots of uncertainty. COVID is still here. Change in the international economy has accelerated tremendously. The economy is very different to what it was 10 years ago, 20 years ago, and so forth. And uncertainty is very high because we don't really know when the vaccine will be available, when the pandemic will be brought under control. So we're, in a sense, sailing blind, waiting for these exogenous shocks to bring us back into the right channel. Thank you for your comments, for raising some very critical issues. If you're interested in knowing what countries are doing to respond to COVID, including in the financial regulatory area, the IMF is keeping a database which is updated every week that summarizes what each country member of the fund is doing. You can find it just by Googling Policy Tracker IMF, and you'll get a very detailed exposition of what each country is doing. And so the other area of intense, a few other areas of intense work in the fund, Alok mentioned the position of emerging markets having to deal with very volatile capital inflows that, depending on what's happening sometimes across the planet, might flow in or out of a particular country. And we've had a number of episodes the last 5 years of capital outflows from emerging market because of changing risk perceptions. The last one was, of course, in March. So the IMF is looking at the policy tools that authorities have to deal with the situation. It is what economists at the fund call the integrated policy framework, which is to look at different instruments like macroprudential policies, foreign exchange intervention, and so forth, to see what the right combination is in the context that a country is facing a shift in capital flows. The fund has also lent money to over 75 countries since COVID has started, so there's been a lot of demand for fund financing. But as we try to keep up with a rapidly changing and uncertain world, having these conversations with people like you are extremely useful to illustrate what is really happening in the ground and really across the globe. So I thank you very much for your time, for your clear expositions, and I hope that you will all stay safe in these very difficult times. Thank you very much.
Thank you, Louis.
Thank you very much.
Thank you, Louis.
Thank you, Louis. Thank you for doing this. Thank you all. Thank you,
Thank
José.
you.
Thank
Bye-bye.
Bye-bye. Bye.
Thank you.
Bye-bye. Thank you.
Bye-bye.
Thank you.